JBlog, 14th of August 2011. I think the first chart that is interesting to look at today is the VIX, because the VIX is an indication of what's going on in people's psychology. And psychology, after all, is what takes over when fear and greed become extreme. So this is a VIX chart for the last year. And we were going along here and the VIX was dropping, which means that people were less and less worried about something going wrong. Then there was a bit of a spike here that lessened off. Once again it went to the bottom, and then of course over the last 2 weeks this enormous spike here in fear that appeared, that has dropped back again at this point. Basically, when I talk about the VIX and I talk about the psychology, I've defined today's investors, I can't really call them investors anymore, but the psychology of the United States is really that of a manic depressant bipolar. Everything is either absolutely fine and couldn't get better, or everything is absolutely bad and couldn't get worse. And these swings between these sides, between these polar extremes, are very strong, I find, in the US investor. Where you have these spikes, which is what makes investing there so tricky, simply because you can go a long way where people like myself think, no, this isn't working, this is wrong, this can't go on forever, and it goes on way longer than you would think there's any fundamental reason why it should. And then just when you start thinking, hey, perhaps this could go on, then we have a really bad day, or a bad few weeks in the market like this. Now we're looking at the New York Composite, and of course this rally that has been going on forever, mostly fed by QE2, and then it flattened out, and then suddenly this sell-off that uh, perhaps was based on the downgrade of the S&P's of the S&P of the U.S. Debt rating, which I personally think was fully deserved. In fact, I was more along the lines of, why hasn't this happened before? Because obviously there's a bunch of clowns in charge and they don't understand that yes, money matters, debt matters, and sooner or later there is a line in the sand that you just cannot step across, where the markets tell you, no, you have been bad, and we're not going to lend you any more money. Now, realistically, nobody's been lending the United States government any money for at least the last 6 months. Bond sales have basically been funded by the Fed indirectly through its membership banks. The Chinese have stopped buying American debt for all intents and purposes quite a while ago. Nobody's really else is stepping up to the plate. So other nations have already said, no, we don't want to lend you any more money. We have enough paper, thank you. And then this is a weekly chart of the S&P, of the New York Composite, and it has basically erased all of the gains that QE2 has created, and now it's bounced back a little bit over the last week again. But basically we've hit the lows, so all of the money that has been spent on QE2 is basically worthless. It's lost. One important thing to look at from a technical point of view here, this is the weekly chart, and the exponential moving average, the 1030 cross has happened, which, if you look at this, doesn't happen very often. That's why I like looking at the 1030, simply because it doesn't cross very often. And if it crosses on the daily, that's one thing. If it crosses on the weekly, that is usually pretty bad. There was a cross over here that did not in the end materialize because of course QE2 came about. Now there's talk of QE3. I'm not sure if lawmakers have much of a stomach for QE3 after they've seen that QE2 didn't really do anything except drive the government into even more debt and make the situation even more dangerous. Um, So, as I said, these lines do not cross very often, and when they do, they stay in effect for a very long time. So, will they stay apart here? Are we looking at another bear run? I do believe so. I believe we will be back in recession in 2012. Realistically, the Fed announcement that has said that interest rates will not be moved from zero um, before the middle of 2013 is basically an admission by the Fed that we are going to be back in recession. And of course, that hits the rest of the world as well, because if American demand for goods disappears, then um, Chinese manufacturing will be hit seriously. If Chinese manufacturing is hit and is already being hit because their um, internal demand is simply not big enough to consume their goods. So if Chinese no longer have to create all of these goods, that will hit Germany, because Germany is a major exporter to China in terms of machinery. Less machinery will be needed, and Germany is the only engine that still keeps Europe running. So that will hit Europe. It'll be ugly. I think it will be very ugly. And this is basically a warning shot right here that something is wrong. As I said, these things are hard to time. I had thought this would happen much sooner, and if it had happened much sooner, the crash would not have been as severe. But now that we're this far down the road and we're starting to run out of road to kick the can down, it could very well be ugly. Now, in the meantime, I do expect a bounce here, simply because these markets are amazingly oversold at this point. If you look at the RSI, the short-term RSI, as well as the longer-term RSI, we have hit an oversold value. So obviously, there's going to be a bit of a snapback rally happening here. If we look at the weekly chart, we are just at 33 on the RSI. Again, very, very oversold. And whenever you get that sort of oversold thing, people will jump in because they think there's value there. Let's look at currencies. The Australian dollar has a big exposure to China, and that is why the Australian dollar has dropped from 110 down to 103. It could go much lower. When you're looking at the Australian dollar long term, it could go down to as much as 50 cents. So there's a major potential downturn in the Australian dollar here, and perhaps I will think about shorting that at one point. Last week, one of my big winners was actually shorting the Swiss, and that was a good deal because, of course, the Swiss dropped by 5%, and that turned out very well. The British pound doesn't know where it's going. It's probably overvalued, but not that overvalued. It's one possible destination outside of the majors. The Canadian dollar has dropped below its 200-day moving average to 101, and it was actually at par from the 106. Of course, Canada being another major resource economy will be hit when China and the United States and Europe are hit. So I expect the Canadian dollar will go lower. The advantage is that Canada actually has the best balance sheet out of the G8. So that does look good from that point of view, and it does make everything the world needs. The euro has been flat. Europe, of course, is in big trouble, especially now that France has a potential to be downgraded as well. Their banks show some problems. Gold, of course, gold has been going up almost. Um, sorry, almost. I pushed the wrong button here. Almost parabolic, and has had a bit of a pullback, but that's where people can escape if they have nowhere else to escape. 8,000 years of financial history and gold. When push comes to shove, people buy gold. They like it. New Zealand, another currency that is probably overvalued, another resource economy. Oil has been dropping. That was an interesting move, down from 115 down to 86 now on the fears of less demand. Could very well be. The Swiss here, I actually sold it short somewhere right up here because this was going parabolic, and I just took a gamble and it paid off very nicely. The US dollar is going sideways. I don't think it's got too much more room to the downside, because it is, even though it is also a flawed currency, chances are if things go bad, people will escape into the US dollar and drive it up higher. That would be my take on it. So I am long US dollar at this point. And the yen, of course, is a place where people like to escape to as well, simply because there's a lot of it. Let's see. World indexes, everything is basically bad, has dropped. So this wasn't just something in the United States. Everyone has dropped. South Africa, China looking really bad here. There's lots of protests in China. China could actually be facing a meltdown coming up pretty soon, maybe in October, maybe in the next year. But lots of people have made lots of money in China, but the vast majority have not made money or have made very little money. But their inflation has skyrocketed, and the common people are not sharing in the growth, and the common people are not happy with that. And that seems to be happening all over the planet. Hong Kong, major drop. India's had a major drop. Indonesia had a bit of a drop, doing a little bit better. Japan had a drop as well. Of course, the earthquake was the big drop here, so it was already pretty low. And just looking at the core sectors, at this point, really everything is linked. Everything is part of an ETF. Everything is part of the futures market. And when they're dumping things in search for covering their margins, then they dump everything. So materials are down, energy is down, financials are really down. Industrials are down. This is all the same chart for all intents and purposes. All sectors are down. There's a few better ones, defensive sectors like health, utilities, and consumer staples, but in general, the entire market tanked. So my take is that it will get worse, but there'll be a short-term rally, maybe 2 weeks to 2 months at this point, and in September, October or so, we should tank further, because the house of cards that I've been talking about for the last 2 years is once again collapsing. You cannot spend your way out of debt, and recovering out of this is going to be hard work. There's more and more voices starting to talk about deflation rather than inflation. I am also tending towards deflation camp. And in a deflation, what you want to hold is cash. Really, cash is the best thing to have in a deflation, and cash-like instruments, from backed from entities that you can trust. So gold is probably a good one as well, but I like cash at this point, and I have a lot of cash. There'll be more deals down the road. Keep your powder dry and be patient. But for now, I'm trading a little bit on the bullish side, just because of this snapback rally, but ready to jump any second. Anyways, that's all I have for today. All the best. Good luck. Make money next week. Bye.